Ready to kickstart your investing journey? In this video, we'll cover 30 essential tips for beginners to help you grow your wealth, avoid common mistakes, and build a strong financial future. Whether you're just starting or looking to refine your strategy, these tips will guide you every step of the way. Let's dive in and make your money work for you. Tip 1. Start with an emergency fund. Before investing, make sure you have an emergency fund. This is your safety net for unexpected expenses like car repairs or medical bills. Aim for 3 to 6 months of essential expenses saved in a high-yield savings account. Why is this important? Because without it, you might be forced to sell your investments at a loss when life throws a curveball. Investing is important, but financial stability comes first. Build your emergency fund today and invest with confidence tomorrow. Tip 2. Understand your why. Why do you want to invest? Defining your goals is the first step in your investment journey. Are you saving for retirement, buying a home, or just growing your wealth? Knowing your purpose will guide your investment choices and keep you focused during market ups and downs. Write down your goals and use them as a roadmap. A clear why leads to smarter financial decisions. Tip 3. Learn the basics of compound interest. Compound interest is your best friend in investing. It's when your returns start earning returns, creating exponential growth. For example, $100 invested today at 8% annual growth will double in about 9 years without any extra contributions. The earlier you start, the more time compound interest has to work. Start now and let your money grow itself over time. Tip 4. Avoid timing the market. Trying to predict market highs and lows is a losing game, even for professionals. Instead, focus on time in the market, not timing the market. Consistently investing over time smooths out the ups and downs and maximizes long-term growth. Be patient, stay invested, and trust the process. Tip 5. Diversify your portfolio. Diversification is key to reducing risk in investing. Don't put all your money into one stock or asset type. Spread your investments across sectors, regions, and asset classes like stocks, bonds, and ETFs. Diversified portfolio helps protect your money when one part of the market underperforms. Remember, don't put all your eggs in one basket. Tip 6. Start small, think big. Don't wait until you have thousands to invest. You can start with as little as $10. Many apps let you buy fractional shares of big companies or invest in ETFs with small amounts. Starting small builds the habit and gives your money more time to grow. Start today. Even small steps lead to big results. Tip 7. Focus on low-cost investments. Fees eat into your returns over time. Look for low-cost options like index funds or ETFs with low expense ratios. For example, a 1% fee might not seem like much, but it can cost you thousands over decades. Keep costs low to keep more of your money growing for you. Tip 8. Automate your investments. Make investing a habit by automating it. Set up automatic transfers to your brokerage account or use a robo-advisor. This removes the temptation to time the market and ensures you're consistently investing, even when life gets busy. Automation makes investing easy and stress-free. Tip 9. Know your risk tolerance. Understanding your risk tolerance is essential. Are you comfortable with the market's ups and downs, or do you prefer steady growth? Your risk tolerance will guide whether you invest in volatile stocks or safer options like bonds. Knowing yourself is the first step to building a portfolio you can stick with. Tip 10. Invest for the long term. Investing is not about getting rich quick, it's a long-term game. Markets will go up and down, but historically, they rise over time. Be patient, stay invested, and let compound interest do its magic. Long-term investing builds wealth steadily and securely. Tip 11. Educate yourself continuously. Investing isn't a one-time decision, it's a skill you develop over time. Read books, follow trusted financial experts, and stay informed about the market. The more you learn, the more confident and successful you'll be as an investor. Remember, knowledge is the best investment you can make. Tip 12. Avoid emotional decisions. Emotions and investing don't mix. Fear can make you sell during a dip, and greed can make you chase risky opportunities. Instead, stick to your plan and focus on your long-term goals. Staying disciplined, even during market volatility, is what separates successful investors from the rest. Tip 13. Reinvest your dividends. Dividends are payouts from companies to their investors. Instead of cashing them out, reinvest them. This boosts your portfolio growth through the power of compounding. Many brokerages offer dividend reinvestment programs, DRIPs, that automate this process. Let your dividends work for you. Tip 14. Don't overlook index funds. Index funds are perfect for beginners. They track the performance of an entire market, like the S&P 500, and offer instant diversification. Plus, they usually have low fees. With index funds, you don't need to pick winning stocks. You win with the market over time. Tip 15. Keep an eye on fees. Fees might seem small, but over time, they can cost you thousands. Watch out for high management fees, transaction fees, or hidden charges in mutual funds or platforms. Choose low-cost options like ETFs or robo-advisors. Every dollar saved in fees is a dollar invested in your future. Tip 16. Monitor but don't obsess. Keeping track of your portfolio is important, but checking it daily can lead to stress and impulsive decisions. Set a schedule, like once a month, to review your investments. This helps you stay informed without overreacting to short-term market changes. Remember, investing is a marathon, not a sprint. Tip 17. Don't borrow to invest. Investing with borrowed money is risky, especially for beginners. Market downturns can wipe out your gains and leave you in. Instead, invest only what you can afford to lose. Building wealth takes time. Don't rush it with unnecessary risks. Tip 18. Take advantage of tax-advantaged accounts. Tax-advantaged accounts like IRAs or 401ks or their equivalents in your country can help you grow your investments faster. They offer benefits like tax deductions or tax-free growth. Always maximize these accounts if they're available to you. It's free money for your future. Tip 19. Be skeptical of hot tips. Be cautious when someone tells you about the next big stock. Hot tips often lead to losses, especially if you don't understand the investment. Do your research and stick to your plan. Remember, if it sounds too good to be true, it probably is. Tip 20. Start now, not later. The biggest mistake is waiting to start. Time is your most valuable asset as an investor. Even small amounts invested today can grow significantly over decades. Don't wait for the perfect moment, it doesn't exist. Start now and let time work its magic on your investment. Tip 21. Start with what you can afford. Don't feel pressured to invest large amounts at the start. Even small contributions matter and will grow over time thanks to compounding. Focus on building the habit of investing regularly. Your future self will thank you. Tip 22. Understand risk versus reward. Every investment comes with risks, but the potential reward can vary. Higher returns often mean higher risks. Know your risk tolerance before investing and align your portfolio with your comfort level. It's okay to play it safe if it helps you stay consistent. Tip 23. Automate your investments. Take the guesswork out of investing by automating your contribution. Set up a monthly transfer into your investment account. This set it and forget it approach ensures consistency and removes the temptation to spend instead of invest. Tip 24. Don't try to time the market. Even professionals struggle to time the market perfectly. Instead of guessing when prices are low or high, invest steadily over time. This strategy, called dollar cost averaging, reduces the impact of market fluctuations and builds your portfolio consistently. Tip 25. Build an emergency fund first. Before you start investing, make sure you have an emergency fund. The safety net, ideally 3 to 6 months of expenses, ensures you won't need to sell investments at a bad time if unexpected expenses arise. Tip 26. Stay patient. Investing isn't about getting rich quick, it's about growing wealth over time. Stay patient and stick to your plan even when progress feels slow. Wealth building is a long game and patience pays off in the end. Tip 27. Research before you buy. Never invest in something you don't understand. Whether it's stocks, ETFs, or bonds, take the time to research the company, sector, or market. Knowledge reduces risk and increases your confidence in your decision. 28. Keep your emotions in check. Fear and greed are the enemies of smart investing. Panic selling during market dips or chasing after hot stocks. Stick to your plan and trust your research. Successful investing requires discipline and a calm mindset. Tip 29. Have a clear goal. Know why you're investing. Is it for retirement, a home, or education? Defining your goal helps you choose the right investments and stay motivated. With a clear goal, every step you take gets you closer to your dream. Tip 30. Celebrate small wins. Building wealth is a journey, not a race. Celebrate milestones along the way, like hitting a savings target or earning your first dividend. Recognizing progress keeps you motivated and focused on the bigger picture. Thanks for watching. If you found these tips helpful, don't forget to like this video and subscribe for more simple and actionable advice on investing and personal finance. Got questions or your own investing tips? Drop them in the comments below. I'd love to hear from you. Let's grow your wealth together.